Hi, it's Neil Thomas from NW Dream Homes for You and Best Choice Realty. And in this video, we're going to talk about the different types of home loans you can get when buying a home. Today, we're at Home Street Bank with Arlie Seaton and the Seaton team. So let's get started. So Arlie, what are the different types of loans?
Well, that's a pretty broad question in regards to the mortgage side of things. There are many different types of loan products available out there. You have programs that start off with as little as zero down, such as USDA, VA. You have FHA, which is a low down payment, and then you move into the kind of conventional loan product, which is more of a larger down payment situation for a buyer. Each one of those products has their own pluses and minuses, and we're happy to discuss a little bit in detail with you.
Okay, so let's talk about conventional loan. Let's start with that.
Sure. Conventional loans typically are a loan product that is, we see conventional loans typically used for a borrower who might be buying their second or third home. These are products that have a down payment requirement of at least 5%. Which most of our borrowers on conventional loans, they fall under between 5 and 20% that they put down. These are loans that if you hear the term Fannie Mae or Freddie Mac, those are the entities that are the securitizing forces for conventional loans. They're going to have a little bit higher credit requirement in regards to the process, but there are some advantages to the conventional loans in what you can, in regards to if you don't have 20% to put down, which is the line where you would have mortgage insurance. Any loan that does not have 20% equity at the time that we close has to have some type of mortgage insurance on a conventional loan. But there are some flexible things that we can do with those mortgage insurance, such as upfront mortgage insurance that's rolled on top of the loan or paid by the seller or the buyer at closing.
Okay. What about VA loans?
VA loans typically are obviously for Veterans Administration. There's a specific pool of people that qualify for those loans. You have to have at least some service time. Right now, the active duty service time is actually 90 days because we are considered in a wartime zone officially. So there are some other requirements if you've never been fully active duty but you've been National Guard. There is a limit of 6 years that you have to be Guard, but there's a certain amount of hours that you have to have attained being National Guard. So those are very tricky, and you really should talk to a lender and make sure your certificate of eligibility, which is a form that we get from the VA that allows us to know that you're eligible for those products, is available. So that's something you definitely want to have our lender take a look at. But the VA loan is a very, very good loan in regards to the pool that we have out there. It's a zero down. You're not required to put any money for a down payment, and if we can get the seller to pay closing costs, you can have what I call a zero down payment and zero out of your pocket for the closing costs. Right now in our area, it's very common for us to get sellers to pay anywhere between 1.5% and 3% towards your closing costs, which allows us that potentially to provide a loan at that. One of the things that I always like to tell people on the VA loans that is important is it is a situation that if you have a significant other that you're not married, the VA requires both entities to be married in order for both people to be on the mortgage loan. So if you have a significant other and you want to buy a house with them, you can't use their income to qualify until you're officially married. In Washington State, because of the same-sex marriage laws, they do allow that provision to be extended towards families for those as well too. There's a specific process that has to go through VA, but that has been extended within the state of Washington as an option as well too.
Is there any cost from the VA for a VA loan?
Depending on the borrower's situation. Now, we never like to hear that anybody has a disability, but there is what's called a VA funding fee. And the VA funding fee is their version of mortgage insurance. Mm-hmm. So for a first-time user, the funding fee is 2.15%, and any subsequent use, if you don't put any money down, it's 3.3%. This is rolled on top of the mortgage. So for every $100,000 you borrow, for example, on a first-time user, if they bought a house that's $100,000, their loan would be $102,150. That funding fee rolled on top. If a borrower has gotten out of the service and has any type of disability claim, 10% or greater, they're never charged a funding fee on their loan. So it truly is the best loan product out there. Also, the VA rates tend to be lower than the conventional rates. Right now, we're seeing rates as low as 3.625 on a VA rate, but those will vary obviously. Mm-hmm. But you're typically going to get a lower rate on a VA loan than you will on a conventional mortgage.
What's a USDA loan?
So a USDA loan is also a zero down loan. It's through the USDA, which is not to be associated with everybody thinks of food when they hear that. It's a rural housing and development. And to use the term rural housing in this area, it's actually very subjective. People often think, oh my gosh, I have to go buy the Windlock to buy a house to get rural housing. There's areas in Tumwater, and especially coming October 1st, there's a new map coming out that's actually increasing the amount of areas that's available in Thurston County. So you're going to have a lot of more options, especially southern areas that we have down here. Yelm Highway is going to kind of be a deriving point now where on the south side of Yelm Highway that's going to be eligible for USDA. My house, I live in Tumwater right next to Black Hills High School. That area is going to open up to USDA. Mm-hmm. So it's a zero down loan. You have some income qualifications that you have to have. The income qualifications are based on family size, but typically, to get a general rule of thumb, if your household income exceeds $87,000 for the year, you're going to probably be writing that line. If you have children and they're in daycare, the USDA does allow us to deduct some daycare expense for you to qualify on there, so that can help people on there. It is a loan that maybe takes a little bit longer than other loans because it does have to go directly to USDA themselves, and they have to review your income and stuff. So it can add a couple weeks to the process, but it is a fabulous loan. Again, the rates on that one are extremely low as well too, and it actually has the lowest portion of monthly mortgage insurance of any loan product out there, with the exception of VA that does not have any mortgage insurance.
Okay. So then let's talk about FHA.
Mm-hmm. FHA typically is the number one loan product out there that is usually introduced to somebody that's a first-time home buyer. It is a 3.5% down loan product, and that down payment can actually come in the form of a gift. What a gift is anybody that has a direct tie to you. Typically it's a family members, but you could also make a case for outside family members if you can prove a close personal relationship with the borrower or with the gifter, that they can give you the down payment for that product. The benefits of the FHA are they have a little bit less credit standards. We could actually go down to 600 credit score for an FHA. Your debt to income ratio can go a little bit higher. You're not constrained to the 45%. You can actually go up to 50%. And with a strong borrower, we can actually go above 50%. The drawbacks of an FHA loan have to do with the mortgage insurance. Several years ago, with the mortgage meltdown, the hardest hit group out of that were FHA borrowers. So HUD, which is the overseeing entity for the FHA loan, had a lot of losses because of foreclosures. So they've decided to raise their mortgage insurance premiums on that loan. In addition, they've made that mortgage insurance permanent. So no matter what equity position that you have, you're forced to have that mortgage insurance. So typically most people that get in an FHA loan are probably going to be looking to refinance out of that within 4 to 7 years, depending on their equity in their house. But it is a wonderful product to get into a house. It is a very, like I said, low interest rate product, and it has a lot of flexibility for people that need to get their down payment from different sources as well too.
What about FHA rehab loan?
So an FHA rehab loan is otherwise known as a 203K. So this is a program that you can identify a property that might need some work and do what I call a mini construction loan to fill that property to its need that you required it to. It's a more established process, and it can be a little bit of a bumpy road. I always tell people the FHA 203Ks are not the easiest loan out there. You will experience some rockiness in there because of the different types of things that we have to do with those. You have somebody who is an FHA inspector go out there, and they give their recommendation of what needs to be done on the property, what they estimate the costs are. That has to kind of match up with the bid process that you have with the contractor. But it is a way to take a house that might not be suitable for moving in right away and really customizing it to your own self. There actually is an alternative to a 203K as well too. Conventional has a rehab loan as well too. So if a borrower has a little bit more down payment that they can do and a little bit higher credit score, the Fannie Mae renovation loan is a better option than the 203K. Again, both have the same process revolving. All the work has to be done by a contractor. That's a big thing. Some people will go into a house going, oh, I can do the flooring. Oh, I can do this. Mm-hmm. No, we have to make sure that all the work is done by a licensed contractor to make sure that it is done to code.
Okay, so when somebody gets a rehab loan, when they close, you guys just give them cash to go do this stuff?
No, see,
How does that work?
there's a draw process within it, just like any type of construction loan. So first thing we're going to do is we're going to pay off the seller who's selling that property. And then built into our loan amount, we're going to have based off of the cost plus a certain percentage to allow for cost overruns. As work is done on the property, the contractor then applies for the bids, applies for the draws for them to get paid for their work. So once the house is fully completed, if there's any monies left over, that goes towards the principal balance of the loan. But typically that draw process is where, the bumpiness can kind of occur sometimes, depending on if the contractor's done enough work to warrant a draw. We have to make sure that that's the case based off of inspection, going out there and making sure the work is completed.
So just to make sure everybody's clear on this, at no time is anybody just going to get cash handed to them.
Absolutely not. Yeah.
So Arlie, getting back to the FHA, is there any kind of help other than a gift somebody can get for the 3.5%?
Yeah, there's actually a couple programs that through the Washington State Housing Finance Commission called the Home Advantage that allow for to explain it in a short term, it's one of those ones you really like to have somebody sit down. But essentially, you get a second mortgage that you attaches to the property that the Home Advantage or the Washington State Housing Finance Commission provides to you as a down payment. It essentially is somewhat I consider free money. It's a zero interest, zero payment loan. What that means basically is there is a lien attached to the property that has to be taken care of at some point in 30 years. But if a borrower sells the property, that's what pays that lien off, because it's tied to the title. So it is a wonderful program. They do have a slightly higher interest rate on the first mortgage than the normal conforming, but again, it's a vehicle for somebody that doesn't have the capability to come up with their own down payment, either from a source from a gift or their own selves. The income limit for that property is actually pretty high. It's $97,000 for qualifications, and you do not have to be a first-time home buyer to qualify for that program. That's what makes that program a very appealing program to people who even maybe had a situation several years ago where they owned a house and now are trying to buy another house and don't think that they have any options because they haven't had a down payment saved up for buying a house. So again, it's through the Washington State Housing Finance Commission. You can find information on their website at wshfc.org. A lot of good information that gives you some specifics on that.
Yeah. So again, if you're in the market to buy a house, and you need a mortgage, I highly recommend sitting down with Arlie. He's quite an expert on all this stuff. He can go over all your options. If you talk to a different lender, I still recommend that you ask them about all these different type of loans. Figure out which is the best loan for you. And that's the real key here, is to figure out what works best for you. All right, you have a good day.